Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Central Time, and I'm recording this in preparation for the market day of September the 10th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive in to our overnight. And at the time of this cut, it really was essentially a scratch play for all four of the broad market indices. The S&P, literally half a point from its close. The Russell, 1.7 from its close. NASDAQ, 4 points off of its close. And the Dow down 8. So for all those, that's relatively scratch. In terms of crude oil, it was up about 1/3%. Euro was scratch. Bonds was down about 11/16, or about 0.42%. And gold was up about 0.4%. A little more activity going on in overseas action. China was down 1.4%, Hong Kong down 2.6%, Japan down 2.5%, Germany down about 0.7%, and United Kingdom down about 1.2%. Obviously, today being Thursday, we have the usual Thursday reports with the weekly unemployment claims. That'll come out before the market, of course. And then import prices month over month, and natural gas storage. We do have a little bit of a variant this week. Crude oil inventories is today at 10 o'clock Central instead of yesterday, and that's because of the shift on the holiday. So be aware of that. Also, for you bond traders, there's a 30-year bond auction today, so that could move things around in that market. And tomorrow, look ahead a little bit, we have PPI, core PPI, and the preliminary University of Michigan consumer sentiment, which comes out during the market cash hours. Let's see here, and that should be about it on that front. In terms of current volatility metrics, we've got a number of significant warnings here. For one thing, the VIX, which had dropped 2 days ago, bounced back up yesterday. Short-term VIX is out now back to a 27.9. Also notice that this skew, 137, anytime the skew goes over 135, that is generally a danger sign. So that is also in play for today. IV percentiles really right on the middle of the pack. 52, 47, 48, and 62 finally on the Dow. We did have standard deviation moves put in on the downside for both the S&P and the Dow yesterday. In fact, the Dow had all 30 of its components were down, and the S&P of note there, its 50-day moving average line is really sloping down now. So we continue to see a lot of technical damage shown across all four of these indices, really. If you look at how many days we've had a standard deviation move, it really is livening up. And while we don't see these 3 standard deviation moves anymore, those have aged off. There's still, look at this, 3, 4, 5, 6, 7 of the last 10 trading days for the S&P have had more than a 1 standard deviation move. And if you think about that from a probability standpoint, that really is quite exceptional to have that kind of a clustering altogether. But that's what happens in a market when things become unstable and risk increases. This is one of the ways it plays out. Now, some of these moves were up moves, some of them were down moves, but ultimately, they don't seem to be going anywhere at this time. And indeed, if we look at the charts, here's the SPX, and we seem to be something of a pennant pattern. And we had a wick here yesterday that looked like it was going to break out, but then failed woefully. And you see its close right back down, really into the apex area of this triangle or pennant pattern. And I'm calling it a pennant because of this. While it wasn't one candle or anything like this, it was pretty dramatic. Really 4 days coming from this prior range all the way down to closing down here at this 1866-ish area kind of thing before rebounding. But then we had this classic candle pattern rollover, rejection, and now it's just been in a range within that smaller area in recent days. Probably influenced by the fact that the Fed announcement is looming out there, and it seems, and you look at market flow numbers, that there is a reluctance by the large institutions to really make a decision one side or another. And if they can't make a decision, then obviously, the rest of the players in this market are going to have a hard time following. And indeed, you have to follow the institutions. They're the ones with the big clout, with the big dollars, with the big ability to push real volume and really push markets. And if they're indecisive, then this market's likely to stay really, really choppy and indecisive, being pushed by things like China and Japan and really almost sometimes maybe it might seem really small things, but loom large on a particular day and move the market up or down, but ultimately to end up back, where it was, within the last several days and not really achieving anything. That seems to be what we have entered into at this point up until we get that Fed announcement. Now, as to what the Fed announcement actually does, I mean, that's another subject that you could get into. But you kind of sometimes wonder if indeed, if they raise rates, if people take that as negative. Of course, it's not liquidity coming from the Fed for the markets, and could kind of juice things to the downside there. But if they don't raise rates, the market could also read that as a negative. You might get an initial thrust up, but then have in the next few days a down move, because the reason they didn't raise rates is they don't think the economy's strong enough. Well, that's not saying very much for the economy either. So it's really quite a tricky thing to try to figure out, are they going to actually raise rates, and then how's the market going to respond to that? You see the Russell here, a very similar pattern to the S&P, NASDAQ, very much like the S&P. These are all pretty much locked in with each other. Very high correlations running right now. I know the Russell and the S&P are currently running on the 3-month correlation well over 90%. I mean, they're usually fairly close, but and high, but have been remarkably close of recent. And really, it goes back to these large institution players who have not made a stand as to which direction they think the market is going to go at this point. And here's the Dow. Again, that kind of compression pattern and failure of this potential triangle breakout. But really, it's starting to look more like it's draw a box around this, a rectangle around this. This is more of a sideways consolidation pattern at this point, and would be looking for a breakout. Now, outside of new news coming into the market, you would expect that these kinds of patterns, whether it's a pennant, triangle, or a rectangular box compression pattern, you'd expect all those to break in the direction of the prior trends. So that would mean that they would all break down and probably come down at least to test these former lows. That, of course, could be totally overridden by the Fed. That's what's really causing this compression pattern at this point. And once we get that piece of information and that's fully digested, which might take a couple trading sessions, might not just be resolved in the afternoon after the announcement, But in a couple trading sessions, to take a look and see where we are with the charts at that point, that's probably going to tell us a lot more about where the market's likely to go. Now, September is normally a very weak seasonal month, but then the rest of the year is usually a relatively strong seasonality influence. So that could also play a role in how this also settles out. In terms of a regular daily report, um, this is very interesting. Actually, I missed it. We had a confirmed uptrend literally for one trading session, and then actually with yesterday's trading session, we should have been uptrend under pressure. I didn't catch that it had fallen back down to uptrend under pressure after only one trading session. So really unusual. I understand that an automatic one-day rejection of the uptrend, confirmed uptrend, not totally unprecedented to have such a big negative day following that evaluation, but it certainly is not saying very much for the status of the ability of the bulls to follow through on signals like that. And indeed, if you look at all the confirmed uptrend signals from IBD in 2015, every single one of them has failed to follow through with any kind of bullish action that has ultimately achieved anything. Now, you may have had a short-term bout of bullishness, but then that just rolled over and went negative as the market deteriorated once again and went to market in correction kind of thing. But um, you did have a situation with one day of confirmed uptrend and then failure back into the uptrend under pressure, and that is our current status. Accumulation distribution score on the S&P chart is a D, and NASDAQ an E. GMI index a 0 out of 6. That author is in cash. Primary market condition is in a strong bear at this point, and the decision point scoreboards are still decidedly all red down arrows across all the various markets and all the different time frames. So very, 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 very questionable market for the bulls at this point. Intermediate term market posture did manage to barely hold on to a weekly bullish stance, and you'll see here S&P 32.0, Dow 38.5, NASDAQ actually went into a regular bullish condition, went over the 50 threshold, Russell weekly bullish at a 30.2, but these are, in general, very weak scores, and the line itself, the curve of the line, is certainly not robust. So it's a bit of a divergence from many of the other signals that we're looking at, but something to also keep in mind, and probably, frankly, a better reflection of a choppy market, which we have seen so much of this year. We've had many times these kind of one-day weak bull signals just immediately fail the next day, and this one hasn't failed quite yet, but with yesterday's action certainly wasn't helpful, and if we have a big down day today, would likely flip this market posture, which is based on the intermediate term, would likely flip back over to bearish. In terms of position sizing opinions, you still have on the investor one a 0 recommendation. In terms of the active trader, based on volatility, you still have this at 50%. So a little bit of divergence there, but still both of them kind of warning to be very careful with the initiation of new strategies and how much exposure you probably should consider in your overall portfolio. In terms of the hedge warning status, this remains as a level 2 red light. With the change in the IBD status yesterday, dropped it from a 3 down to a 2. And indeed, we've had some lessening of the factors. Remember, we've had all 5 of the risk aversion indicator scores go to risk on. So there was a number of factors that came into, frankly, changing the score for yesterday's session to a 2, and we remain with a level 2 at this point. But the level 2 is still pretty elevated risk. It's not our highest level of level 3, but it is a red light. That is to say, if you use the analogy of the traffic light, it's red. Do not proceed through the intersection kind of thing. As the vernacular goes here, risk conditions are very elevated, and you should be making various and appropriate moves with your portfolio management, the way you initiate positions and so forth when you're in this kind of a condition. Now, it does not say that it's a prediction that the market is going to crater or really drop or a degree of drop or anything like that. It just says that the conditions are ripe for a deteriorating condition. Not the worst one, that's level 3, but it is certainly still quite elevated. Our normal level being a 0, and that's a full-on bull market, normal conditions. We're quite a bit elevated from that. And indeed, if you look at the various metrics that go into this, not only do we have the market on a decline warning, which has been relatively consistent in recent trading days, but the sharp increase warning again fired yesterday. VIX still above an 18, of course. Distribution day count, of course, restarted with the new confirmed uptrend, which again only lasted 1 day. But distribution day count for the S&P is at a 1 and a NASDAQ at a 1. Literally one trading session into this new counting system. VIX phase increasing skew, again, we mentioned about 135. Yesterday was relatively benign for such a sharp drop. 97 up and 79 new lows on the New York Stock Exchange. So relatively benign there. And as I mentioned earlier, the risk aversion indicators all flagged as risk on. So, something of a lessening risk evaluation coming from that metric. In our special opinions, no real changes from recent trading sessions. Option income strategies, VIX is outside the acceptable window unless you're very experienced and able to handle significant changes in volatility and delta. Probably not a good environment for option income strategies. Much better to do those when the VIX is between a 12 and an 18. Covered calls and put selling. If you are going to initiate new positions at this time, a week before the Fed, which could be very much a binary decision, and the big money players, as we said earlier, are telling you they don't know which way this is going to go. This is a pretty tricky time to be initiating new positions, either in your put selling strategies or your cover call strategies. So just kind of consider all that, and we have definitely come down on the side that conditions are not acceptable for at least the novice traders for either one of those strategies. In terms of sector specific, I think we mentioned yesterday, that if we had any kind of a down day, these were really such neutral lines that they could quickly flip, to all red again, and they just about all did, with the exception of transportation. Everything went back to red on all 3 time frames, so very, very weak here. Also, in terms of the percent change, you see the 1 day, just ugly across the board yesterday, and put a significant hurt on the last 5 trading days. Many of these are, of course, still up for the last 5 trading days, but in the context, again, the 1 month, 3 month, year to date, even last 12-month periods, there's some ugly numbers here, and this is going to take a very long time to heal. So that should be enough for today. As always, if you find what we're doing here is helpful to your trading, please retweet us to your Twitter followers or your StockTwit followers. Like us on YouTube. Subscribe to us on YouTube. If you have direct feedback, you may send that to support@falconglobaltraders.com. That's the email address you see there. Disclaimers as always. Hit the pause button if you need more time to review these. and we'll see you back here tomorrow morning before the cash session open with the market preview from Falcon Global. Thank you. Good trading.